Good afternoon, everyone, and welcome to our webinar today on Pacta for Investors. The Sustainable Investment Platform is very pleased to be working with the Rocky Mountain Institute and WWF Malaysia in the delivery of this program on the Paris Agreement Capital Transition Assessment. Today's session will run for 90 minutes, and just to give you a bit of housekeeping details, there is a Q&A box at the bottom of your screen. All the speakers are happy to take any questions from you, so you just have to click on the box and type your questions in at any time. So it's quite a packed agenda, and I know we have Daisy joining us with her colleagues George and Nicholas, and we have a guest speaker from Sura Investment Management, the head of Sustainable Investment, Maria Ruiz Sierra. So without further ado, I'd like to hand over to Daisy Pacheco, who is the associate for Pacta for RMI, or the Rocky Mountain Institute. So Daisy, over to you.
Great, thank you. Thanks a lot, Navina. Good afternoon, everyone. It's a pleasure to be here again. This is the third webinar out of 4-part Pacta webinar series that we've been having throughout this year. The first one, we covered the introduction to the Pacta methodology, the portfolio alignment methodology that has been now transferred to the Rocky Mountain Institute. This webinar is published online in the SIP platform website platform, if you like to recall that. There is also a second webinar, which was a recorded webinar on the practical implementation of Pacta, so how an institutional investor or anyone interested in assessing their portfolio alignment with climate scenarios can do that through the Capital Transition Monitor platform. So there is a recorded webinar in which we show you the practicalities of the implementation of the methodology. This is the third webinar, as I was mentioning, and in this webinar we will cover the first part of what we call the use cases for Pacta. So how can Pacta results can inform different actions and strategy for investors that use it. The last webinar will be held at the end of October. So we will let you know, so you can also join us. We would like to start by acknowledging the support of the Malaysia UK Pact program, who has been the main funder for this project, and also, of course, we would like to thank the SIP platform for her support in the implementation of these webinars. So for today, we have a very quite big group of presenters. We have today with us George Harris, who's Senior Associate for Pacta at RMI. He's the product owner of Pacta for Banks, one of the other modules for Pacta. We will cover now today. We've been covering Pacta for Investors, but he has been also part of this project since the very beginning, also since last year. We also have Nicholas Dodd, who's Senior Associate also at the Pacta team at RMI. He has a lot of expertise in the sectoral analysis, and he has been working on some of the most interesting projects in which we implement and use Pacta for different strategies. We also have Maria Ruiz, who's the head of sustainable investment for Sura Investment Management, one of the biggest investment managers in South America. So it's a pleasure to have you all. And well, my name is Daisy, as Lavina mentioned. I'm also part of the Pacta team, and I will be moderating today's presentation. We wanted to start by setting the scene with some interesting but very well-known quotes and facts that we might have already in mind, but we thought that it was really important and relevant to start our conversation today by understanding that what we are talking today is actually a big issue that affects all asset types and sectors. So climate change has been in the agenda of financial institutions, supervisors, asset managers, asset owners for a while now. And we know that it has a great impact on almost every sector of the economy. If we talk today in this specific context that we are here in the webinar, it will impact the portfolio returns of asset owners and asset managers, even if they are very well diversified and even if they are global portfolios. So this is very important to keep in mind, and to, even though we know already some of these things, we thought important to set the scene by starting with this. Along with this, we know that some of the most very well recognized scientists on the climate change have found that the impacts are global, will be global. We know, and they have found that there is sufficient global capital and liquidity to close the investment gaps in terms of capital that is required to mitigate and to tackle the climate change issues, but there are still some barriers to redirect this capital to climate action. So that's why we might be having this conversation today. Some of these barriers to the deployment of commercial finance from within the financial sector include, among many others, the inadequate assessment of climate-related risks and investment opportunities. And we think that what we have today for our conversation can fit very well into this context and can help us and give us one of the many tools and resources to tackle this. So with this, I would like to present the agenda for today. So we will start with a very short introduction and recap of the Pacta methodology. So again, this was covered during the first webinar that we held in April, but we wanted to start today by refreshing our memory and talking about what is it that we call Pacta. We will do a short introduction on the different use cases that we will present during these two webinars, today and the next one next month. And then we will jump straight to the use case one, in which we will see how using the alignment results, we can think about designing Paris-aligned investment strategies or Paris-aligned portfolios. For this, we will hear from Maria, who will show us one of the projects that she has been working on since the past year on the design of a Paris-aligned portfolio. Right after that, we will hear from Nick on how we can use company alignment results to inform investee engagements. For this, he will walk us through a case study on the CA 100 plus company alignment assessment, which is one of the case studies that Pacta has been working very closely with. At the end, we will have some closing remarks, final considerations for you to take into account. And then we will have a dedicated time for Q&A. Of course, if you have questions during the webinar, you are more than welcome to put them on the chat. So yes, with this, we can jump straight to the Pacta methodology and use cases. And for this, I will give the floor to George. So George, please.
Great, thank you very much, Daisy. So if we just do a quick recap of the Pacta methodology, and as Daisy mentioned previously, we have a full breakdown of the methodology in the first webinar, which you can find on the SIP platform. So very quick reminder then, what we're looking at on the right-hand side of the screen is our physical assets in the real economy. So with the Pacta scope, we're looking at the power sector, so physical power plants, the fossil fuel extractive sectors, so oil and gas extraction and coal mining. Then automotive, we're looking at automotive manufacturing, so the actual creation of the cars, electric vehicles, internal combustion engines and the such. And then into the industrial sectors, we have steel and cement, again, the manufacture of which. Then also we have aviation, and shipping is still being worked on as we speak. So what we have then is we have these physical assets and we have these forward-looking production forecasts for each technology within these different sectors. We then allocate those different assets to the different companies that operate them. And then via the financial securities, the bonds or the listed equities that these companies issue, we map them to the financial institutions' portfolios. Then what we do is we have to compare these to a kind of climate benchmark. So a climate change scenario is what we use here, the likes of the International Energy Agency being a prominent example. Off the back of that, we can then produce a set of metrics, the first of which being exposure metrics, so showing us how our portfolios are distributed across the different sectors, across these climate relevant sectors, and then how they are distributed within those sectors across the different technologies. Also giving an idea about the geospatial distribution of these assets across the world. The second then group of metrics is looking at our alignment ones. So looking at how the forward-looking production forecasts, the forward-looking build-out plans compare to these different climate benchmarks. So 2 degrees benchmarks, net zero benchmarks, for example. Also business as usual. Then thirdly, we can kind of narrow down into the company level results. So looking at how the individual companies weigh up against these different climate scenarios. And we'll touch a bit more on the specificities of this with the CA100 Plus case study later today. Then finally, we have some risk-based metrics. So here we're looking at the transition disruption metric, which pulls on some of the UNEP FI's scenarios in the form of the inevitable policy response scenarios. So this metric will be touched on in a later webinar that's being hosted at the end of October. And so with that, we can move on to the use cases of today. Thanks. So as we say, Pacta is primarily a portfolio alignment methodology. So it's saying how aligned our portfolio is to these different climate scenarios. Off the back of that, we can then inform different use cases. So kind of the first one, and the one that we're going to look at today, is using this alignment information at the portfolio level and at the company level. How can we think of making climate decision-making and strategy? So Maria's going to talk a bit about how Sura have done this and the case study to follow. And then after which, we'll look at the engagement kind of use case. So how can you use this alignment? How can you use these alignment approaches within engagement strategies and working, in the case of CA100 Plus, in a collective manner to perform engagement with investee companies? Then the next set of use cases, which will be in the webinar next month, we're looking at using Pacta as a climate risk assessment. So kind of identifying our transition risk across these climate relevant sectors, and then think about what we can do about this. And then finally, thinking about climate from a disclosure and reporting perspective as well. So with that, we'll do a quick introduction to the use cases today before handing over to our case studies. So the next slide, thank you. So with the, jump back one if possible. So use case 1, sorry, it's looking at engagement strategies. Yeah, here we go, thank you. So just to give a quick overview, and this is taken from the UN Principles for Responsible Investment, as the type of ESG incorporation strategies that are out there. So the first one, and just to remember that here with Pacta, we're talking about climate change, so a particular element within the E of the ESG broader spectrum. So the first kind of incorporation strategy here is around integration. So this is explicitly and systematically including ESG issues in investment analysis and decisions to better manage these risks and improve returns. The second broad strategy here is screening. So applying filters to a list of potential investment, to a list of companies to see which are in and out of contention for investment. And then that's based on kind of the investor's preference, values, or ethics. So it's like screening. The third one then is thematic climate investing. So this is seeking to combine attractive investment risk profiles with the intention of contributing to specific environmental or social outcomes. And this is where impact investing would fall under. And then finally, we have impact first investing. So this is the idea of patient capital. So waiting a long time for returns. And this is highly focused on kind of the climate outcomes. So those are four kind of broad stroke strategies that you can use when thinking about decision-making and strategy. And then on the engagement side, we're looking more at active ownership or kind of stewardship. So in the engagement definition here, we have discussing ESG issues with the companies to improve their handling, including disclosure of such issues, can also be done individually or in a collaborative way with other investors. Again, sort of CA 100 plus approach is looking at that collaboration with different investors. We'll hear a bit more about that from Nick later. The second kind of engagement strategy here is more around proxy voting. So formally expressing approval or disapproval through voting on resolutions or even proposing shareholder resolutions on specific ESG issues. And so with that, just setting the scene, I'd like to hand over, I think, to Maria now to take us through how Sura Investment Management have been working on incorporating these kind of decision-making and strategies and the role of Pacta within that. So thank you very much, Maria, and I'll hand over to you. Thanks.
Thank you, George. And hi, everyone. It's my pleasure to be here with you today. Thank you to the Sustainable Investment Platform and to RMI to make this conversation possible. I'm about to share what has been and what continues to be our journey, exploring how to align investment strategies with climate goals. So maybe I begin with a brief introduction. I work in Sura Investment Management, as was said before. If you can go to the next slide. Thank you. Sura Investment Management is one of the companies of Grupo Sura. This is one of the largest financial holdings in Latin America. So you know, Latin America comprises from Mexico, passing through Central America and then all South America. Grupo Sura has businesses in the banking, insurance, pension, and investment management business. And then I am in the company that is focused on asset management for institutional investors. We manage over $11 billion and we invest in different asset classes, mainly fixed income, corporate, and sovereign bonds. Then we invest also in alternative assets like private debt, real estate, and infrastructure. And we have presence in 6 countries that you see on the screen. So my role in this team is to lead the implementation of our sustainable investment strategy. That means connecting with all investment teams and all investment processes to ensure that we incorporate environmental, social, and governance criteria at the beginning when we're analyzing the assets, in the meantime, when we have the portfolios and we're managing the assets on our investment strategies, and also when we're creating new funds and new products and new investment solutions for our clients. So if you can move to the next slide. Our sustainable investment strategy defines 3 main approaches that have different objectives and that are very aligned with what George was saying in his last slide. So the first one is ESG integration. What I was mentioning is this bottom-up ESG analysis that we make when we invest on an asset. So before making the investment decision, how we inform that investment decision, not only taking into account financial criteria, but also how these assets are impacting the different stakeholders and also how they are managing the different trends that have an impact on their business, how they're adapting their business strategies to be resilient in the future. So in this first approach, the objective is to identify investment risks and also to demand a certain minimum standard from the companies and the assets that we invest in. The second one is after we have the portfolios, the assets in our portfolios, how we are active in promoting and influencing better sustainability practices. So that connects with what also George was saying, engaging with issuers, equity and fixed income issuers, to use the leverage that we have as the stewards of our capitals, our investors' capital, to motivate conversations with the companies to, for instance, ask what they're doing in terms of climate ambition and decarbonization strategies, and to push to more ambitious activities over time. So there, the objective is to promote better sustainability practices. And lastly, we have thematic investment. That is when we're creating new products and investment solutions, how we incorporate strategies that from the investment thesis focus on assets with high sustainability standards or that have some type of sustainability outcome, for example, that are enablers of the climate transition. So in this case, the objective is to mobilize capital to sustainable assets. So we began this journey a few years ago by the end of 2019 as a articulated philosophy and an action plan across the company. And of course, climate change quickly became one of the main topics and the key issues for us to start exploring how to incorporate into our strategies. Can you go to the next slide, please? Climate change, of course, is super relevant because it has an impact across sectors, across geographies, and it's a risk that is not possible to diversify away from. So we see that climate change has an impact on investment portfolios through physical risks and also transition risks, but also we see that it's relevant to incorporate this type of analysis in our investment management because the companies that we invest in and that we have in our portfolios also have a contribution to the achievement of the climate goals, to limiting the global warming to 2 degrees or 1.5 degrees. So when we started exploring how to move forward with this analysis, we realized that there was a key question: how are our portfolios aligned with climate scenarios? Scenario alignment seemed to be the starting point. So when we started exploring tools, we quickly came to Pacta and started exploring the Pacta tool. And we started talking with the Pacta team because we wanted to understand what the tool meant, how to use it, and etc. We really like the Pacta tool because first, it is based on rigorous scientific foundation, and second, it is promoted with non-profit purposes. Let's say that it's one of the few tools that are out there that is not a product that as ESG data provider is promoting. So we really like that, and we started exploring the free online tool. And then in this conversation with the Pacta team, we realized that it was very important to anchor this analysis in the reality of Latin America. South America by itself has a very clean electricity matrix. Most of our energy is renewable, in particular in Colombia. Most of the electricity that is generated is through hydropower. So let's say it's not very intensive in terms of emissions, but we do export fossil fuels, and that is a big part of our economy. And in many cases, it's also very relevant to feed the public budget itself. So we had to take that into consideration because as countries in Europe decarbonize and the companies that are subject to more stringent regulations have to lower their emissions quickly, what happens is that they tend to sell the most emission intensive plants and refineries to companies somewhere else. And Latin America, in particular Mexico, has been one of the receiving ends of these emissions. So we have to analyze how to create a Paris-aligned strategy in Latin America looks like. So given that context, we decided to create a partnership. If you go to the next slide, please, between Pacta, in that moment was 2 Degrees Investing Initiative, and now under RMI and us to answer a research question of whether it is possible to create a Paris-aligned portfolio with Latin American issuers to anchor this conversation that is taking place globally and that is being very led by Europe mostly to an emerging market reality. And that's what we've been working on the past 2 years, and we're in the end of the research project, finishing up the report that we hope to publish by the end of this year. So if you continue, please. What we did was to define 3 main components for the research. The first one, to create a methodology to assess the climate performance of the issuers in Latin America that gave us a key variable for the portfolio creation from the perspective of their alignment with the Paris Agreement. Second one, an impact strategy, how we explored mechanisms to influence, hopefully, the reduction of greenhouse gas emissions in the real economy, not just align our actions from the asset allocation perspective, but also to use what our leverage as capital stewards to motivate changes. And third, the integration of this climate variable, the climate performance score, into a portfolio construction. Next slide, please. So for the climate performance assessment, for the climate performance assessment methodology, first we needed to determine our investable universe. So we defined a universe of 204 equity and corporate bond issuers from 8 countries in Latin America. And we did this by referencing the main national market benchmarks and also the regional ones, and also crossing that with our own investable universe, like the companies that our bottom-up teams analyze. We realized that out of these 200 issuers, 30% belong to what we call Pacta Sectors. These are climate relevant sectors because are the most carbon intensive ones, so power, oil and gas, cement, steel, aviation. But also the non-Pacta sectors are very relevant in our capital markets. In particular, you can see there that financial plays a big role, and also other industries like food and beverage, materials, and infrastructure are very relevant. So our climate performance assessment methodology had to incorporate also indicators for non-Pacta sectors. And also what we imagine and what we assume at the beginning of the research is that, of course, as an emerging market, it was likely that there were very few companies that were actually aligned already according to the Pacta tool. So we needed to also have indicators that allowed us to assess the little steps that these companies are making towards a pathway of climate transition. So if you go to the next slide, what we did was to create a set of KPIs in 3 categories. The first one is, of course, the alignment with a pathway of 2 degrees or 1.5 degrees below 2 degree scenario. For this, we use the Pacta tool, and it's the first example of how we use the tool, and it's to analyze the alignment at the company level. So we analyze how, using forward-looking data for the next 5 years, how the production plans of the companies or the estimated emission trajectories were in line with different climate scenarios and whether that fell below 2 degrees. Out of the 204 issuers, only 8 are aligned with a below 2 degree scenario. So that means that only 4%, and our assumption was correct. So we then moved to the other 2 categories of indicators. We wanted to check also if the companies had set decarbonization targets and if those targets were in line with the Science-Based Target Initiative methodology. And also we wanted to evaluate the emission reduction trajectory of the company. So we checked if the companies had reduced their absolute emissions in the last 3 years and if that reduction was in line with a 2 degree scenario. As you can see in the slide, in the decarbonization target, 81 companies, meaning the 40% of the investable universe, had set the decarbonization targets, which is very positive, but only 7 have done so in line with science-based target methodology. And in terms of emission reduction, 24 companies have reduced their emission in the last 3 years, their absolute emissions, but only 11 have done it in line with a 2-degree scenario. So in this case, we use both information that was forward-looking and that came out of the Pacta tool, and we combined that with historical data and indicators from different data sources. And what we did was to combine that into a climate performance score that gave us an indication and a ranking of what companies were leading the climate ambition pathway and which were the laggards. Let's continue, please. So the first use that we did of this climate performance score was to connect it with impact strategy. So we know that just aligning a portfolio is not enough to accomplish the Paris goals, because what it does is that it focuses the asset allocation on those companies that are already aligned or doing well. But then what happens with the ones that are not doing well and that need to do well because have an important role in the decarbonization or in the general emissions of the economy and therefore need to decarbonize? We need to also have a strategy for that. So we created a draft or a pilot of an engagement strategy that we piloted last year. We prioritized 20 companies, and what we did to prioritize these companies is first companies that are from Pacta Sectors that have the lowest climate performance scores. So they're not showing any kind of ambition or any real evidence of moving towards a climate decarbonization pathway. And second, those companies that didn't reveal information. So we were also looking to promote more disclosure, and we checked with them the trend of their emissions, if they had a plan to get a decarbonization target, if they had analyzed their climate risks and opportunities, and if they were reporting. And then the third element, if we go to the next slide, was then how to use the climate performance score to create a portfolio, to build an investment strategy. So we created 2 separate portfolio construction exercises, one for equity and one for fixed income, regional, covering all Latin America. And what we did was to combine quantitative analysis, a clustering analysis of how the assets behave, to have different risk buckets and like building blocks that we needed to combine to create a well-diversified portfolio in terms of countries, sectors, and also the specific performance of the assets. And then combine that with a minimum requirement of climate performance. So we wanted to, of course, focus this portfolio on those companies that are aligned or that are moving towards setting a decarbonization targets or that are moving towards reducing their absolute emissions. So tilting the portfolio towards the companies that have more alignment or more ambition in terms of their climate transition. So we combined that using different strategies. You will be able to read more about it when we publish the report, but we tested different portfolio construction methodologies, both optimizing, for instance, in the case of fixed income, optimizing the portfolio construction by focusing only on the companies that have a minimum climate score, but then optimizing to minimize the tracking error to make sure that it doesn't deviate, that the portfolio doesn't deviate a lot from the market benchmark. But in the case of equity, we didn't optimize. What we did was to mix the market capitalization of the issuers with the climate score to assign a bigger weight on the portfolio to those companies with a greater climate score, and then to give a smaller percentage to those companies that were having little steps or had a better relative performance compared to the sector peers, but that were not yet aligned, but that we needed for the diversification of the portfolio. So these 2 theoretical exercises show that it is possible to create a sufficiently diversified portfolio with Latin American issuers that are moving in their climate pathway, climate transition pathway. One of the conclusions is that if we want to create a Paris-aligned portfolio, it's not possible because, as you said, as you could see before, only 8 companies are aligned with a below 2-degree scenario. So we needed to be, given the reality of an emerging market, to give more space to those companies that are advancing but that are not aligned yet. So it's a focus more on a climate transition fund than a Paris aligned fund being strict. Of course, this means that it's a portfolio that will have higher concentration and therefore can have more volatility and higher tracking error in specific moments in time. But that overall, we can create a portfolio that is consistent with the market benchmark, using or focusing only on those companies that have a more ambitious climate pathway. What we did also, if you go to the next slide, was to assess how the alignment of this Paris Aligned Fund or Climate Transition Fund looked like compared to the market benchmark. And this is the second use that we did of the Pacta tool. As I mentioned before, we use it to analyze the alignment at the company level. And in this step, we use it to analyze the alignment at the portfolio level. So as you know, one of the outputs of Pacta is the alignment of the portfolio or the market benchmark with different climate scenarios in different technologies. So what you see on the left is the MSCI Emerging Market LATAM Index. Let's say it's the broad market benchmark for equity in LATAM. In this case, it's compared with the MSCI Emerging Markets in general. And then on the right side, you see the climate portfolio, the portfolio that resulted from the research. So you can see that in oil, for instance, the market benchmark is more aligned in Latin America than in emerging markets in general, but it's still in a trajectory of way more than 2 degrees. And in the climate portfolio, you can see an alignment because it falls on the green area that is the sustainable development scenario. So it's a 2-degree scenario. If you go to the next slide. With gas, something similar happens. The market benchmark is already aligned, but you can see that the climate portfolio, it's more aligned. So it goes even lower. The gas production goes even lower than the average of the Latin American market benchmark compared to the emerging markets broad benchmark that it's in both cases in the red scenario. And if you go to the last one, in hydropower, we see that something similar happens as well. There's more alignment on the climate portfolio than in the emerging market LATAM benchmark, even though the first one doesn't fall in the red part of the scenario, it improves in the climate portfolio. So we see that it's not only possible to create a climate transition portfolio, but when we analyze the outcome in terms of alignment using Pacta, we see an improvement compared to the broad market benchmark. So this is what we wanted to share with you today in this case study, and happy to take questions at the end.
Thank you, Maria. Thanks a lot for your time and for your willingness to share the findings of this project. We have already some questions, but we will leave this for the end. Now I would like to pass the floor to Nick, who will talk us about how to use company alignment results to inform investee engagement strategies. So Nick, the floor is yours.
Great. Thanks a lot, Daisy. Okay, so I'm basically going to introduce our work on climate action in support of the Climate Action 100+ initiative, which is an investor-led initiative. I think it was formed back in, I think it was 2018, 2019. I'll give you some brief background on the initiative itself, recap sort of on what we mean by investee engagement as a concept, as an approach, and then sort of make the link between the kind of metrics and the results that we provide using Pacta to CA 100+, and sort of illustrate how they're used or how they feed into the high-level engagements by the groups of investors. Next slide. Okay, if we can go to the first slide in that section. Yeah. So what is Climate Action 100 Plus? It's a high-level investor-led initiative coordinated by UNPRI. There are a number of other umbrella groups for investors, such as IGCC, which form part of that, the sort of coordinating group that brings together, I think if you look on the right, there are over 600 signatories, amongst which there are sort of large global investors, regional investors, pension funds that are sort of coordinated by UNPRI and other initiatives. It's targeted at the 167 high emitting public listing companies. We can just back to that first slide. Sorry, Daisy. Yeah. And basically they have something called the net zero benchmark, which contains a series of metrics to form the basis for high level engagements with investee companies, with these 167 focus companies that are in a range of different sectors. We started this work when the Pacta team was with 2 Degree Investing Initiative, and now with RMI, we continue to provide results on our members of the technical advisory group. Next slide, please. Okay, and if you look on the website, you can actually see the benchmark results company by company. And basically, they're structured into 2 parts. There are disclosure results with metrics, you see on the left-hand side here, which I think are prepared by TPI. These are very much on sort of management, commitment and strategy, and also target setting by each company. And on the right-hand side, you see there's also alignment assessments, which go into more detail on the kind of capital commitments and alignment along pathways of the company. And you'll see that as part of that, we provide the capital allocation alignment metrics and results into that part of the benchmark. Next slide, please. Okay, I'm just going to, since the focus is on how these are used in engagement, I'm just going to recap on, the question is what do we mean by investee engagement? I thought this quote was quite useful by quite a sort of detailed study on investor engagement. The use of shareholder rights and access by investors, access to companies by investors, to influence the management processes of a given portfolio company, and in fact could also influence then its capital commitments, is what we want to drive at here. And in some instances, investors may also induce large-scale changes in management process across several companies through their intervention, through symbolic targeting of one or more portfolio companies. So really, it's kind of a process of kind of seeking to influence investee companies, and very much interest in capital commitments in terms of what Pacta is intended to do. Next slide. And I think previous work, when we were at 2 Degrees Investing Initiative, focused very much on the impact of investment decisions, and kind of academic research and also research in the sector has shown that engagement was one of the most impactful mechanisms that can be used by investors, particularly investors in public listed equity and bonds, in order to have an impact on the decisions of companies and also their capital commitments and their assets in the real economy and their emissions. So it's a potentially impactful mechanism to use, and one of the most direct ways that investee can influence companies in a portfolio. And it's very much, in order to achieve that impact, it's very important to focus both on what's being requested of the companies in the engagement, and also to monitor the outcomes from the engagement process. So these are sort of key concepts to understand. We actually developed, this is partly based on literature and some work we've done, also with Maria on the Paris-Aligned Fund project, a kind of escalation scale, so you can actually look at the kind of way in which you can, different ways in which you can influence an investee company via different engagement modes. These range from kind of routine engagement via the investor relations office, informal meetings, also exercising shareholder rights, through to more sort of activist engagement mode, where there's more direct bilateral contact via the executive, directors, consultants, moving into sort of public statements in the public domain, working collaboratively with other investors to increase the sort of influence. And then we see increasing actually use of more confrontation engagement modes, where if there's evidence that there's not enough action being taken or not enough outcomes being achieved, or the strategic direction of the company is very misaligned, kind of intervention by investors to, for example, change composition of the management, and with the sort of last step, almost a kind of threat, if you like, to divest holdings if progress is not forthcoming following the sort of ratcheting up of engagement. So we see that as a sort of scale that can be used in terms of a level of activism, if you like. Next slide. Okay, and we see in terms of the engagements by Climate Action 100, you'll see in some of the material and the reports in the public domain, these are the additional initiatives that are coordinated and they're collaborative between the investors, bilateral engagements with individual companies. What you see in the reporting is that the variety of different outcomes being requested, short, medium, and long-term. The short, medium, and long-term emission targets are set by companies. Technology investments or early retirement of assets are amongst the sort of requested outcomes, and an improvement in the board level climate competence or sort of strategic planning. I think we saw last year in their report there were 14 shareholder proposals moved by or coordinated by Climate Action on climate action to AGMs. We saw, for example, a sort of major changes in ExxonMobil's board structure, which they were also involved in, along with another specialist investor. We also see efforts to sort of request or take votes on transition strategies and plans to AGM. So there's a lot of sort of high-level engagement activity, both bilaterally with companies and also through shareholder rights, exercising shareholder rights in AGMs. Next slide, please. Okay, and if we move to this last section, I'm going to just sort of take you through the sort of metrics and how they're used. I'm going to focus in on the metrics for the power sector, referred to electric utility. Here we provide 3 different types of metrics. The first one is a comparison of each individual company with the technology mix of the sector average to look at how the company compares. Then we have 2 alignment metrics. The first one is at technology level. In the case of power, it's for coal, gas, oil, hydro, nuclear, and renewable power technologies. And the question we seek to answer is, how does a company's 5-year planned forward-looking production for each technology compare with climate change scenario pathways for a sector? And we use IEA scenarios to measure the alignment on a 5-year forward basis for each company, 4 to 6 technologies. And then we aggregate those into a company level scenario alignment assessment. Again, that's based on the 5-year forward-looking production plans to look at the alignment of the company as a whole, weighting the different technology performance. So this gives a scenario alignment result for power companies. And then for steel, we also provide these for automotive, but I'm just going to show you the power metrics today. But basically, automotive metrics are the same in terms of alignment assessment. For steel, cement, and aviation, a little bit different. We use emissions intensity metrics because we don't have the same clear sort of transition between different technologies. So we measure the overall emission intensity normalized to a unit of production of steel, cement, or an activity metric in terms of passenger kilometers flown for aviation. And we focus on measuring alignment of the sort of present day emission intensity of a company with the 2030 target in the scenario. And what we see with using the 2030 target is it stimulates dialogue with the investee companies, both on what they can do at the moment in terms of available solutions to start reducing emission intensity. But we also see evidence that it focuses their attention on what new technologies will be required to meet that 2030 target, that they already need to be involved somehow in bringing to commercialization. We do actually see evidence of that with some of the investee companies. So we use this 2030 target. And the question is, we pose there is how far is each company's present emission intensity from the pathway target for the sector. You can consult the more detailed methodology in the documentation up on the CA100+ website. Next slide. This is just an example. On the left-hand side, you see the scorecard, which you can find on the CA100+ website for each individual company. You'll see the alignment results with a kind of traffic light indicator for each technology, and then on the bottom row, the company aggregate result there. And investors can sort of look both at the aggregates, how the company as a whole is performing, and then they can look at what's driving that and look at the different. And each company might have a portfolio of particular power technologies, and you can look into how this strategy is for those different technologies. And then in the summary we provide to CA100 on the right-hand side, this is the overall results for all of the company, all 33 companies. And you can see with the traffic lights here where the sort of in which technology are most aligned. Actually, we do see progress on coal. There are a number of companies there that have actually reduced production, but you can see there's a lot of work to be done on renewables, for example. Many of the companies are significantly misaligned, which is a trigger that more investment is needed there. And the next slide. And you can see this also with the aggregate result. This is very much driven by the renewable technology result, because the weighting in the scenario is towards a very large change in production capacity for renewables versus the other technologies. So this result is very much driven by specific investments in technology, and if they're not keeping up with the pace of the scenario in renewable technologies, for example. Next slide. And this is the kind of feedback we provide to sort of to then use in engagements. I mean, it's very high level, but we just try and use the results to sort of indicate what kind of questions should be asked going into engagements. For example, on coal power, we certainly see there are positive signs of reduction in capacity amongst the companies, but actually we think the next stage in engagement is to then ask, well, obviously there are some companies that still need to be sort of driven to sort of in terms of managed phase down of their coal. But for those that are achieving that, which I think is over half the companies, how are they achieving those reductions? Is it through closing assets or is it through sailing those assets onto other companies? And so there wouldn't actually be a reduction in emissions. And again, Maria actually referred to a similar issue occurring with oil and gas assets. We also see that I mentioned a large number of companies are misaligned for renewable power capacity. And so very much a focus and engagements is needed on capital commitments to build out of new renewable energy capacity. Are they being prioritized over other technologies such as gas, where the companies do all seem to be aligned? And will that capital commitment be at the scale anticipated by the scenario? So these are the suggestions we fed into the engagements. Next slide. Okay, and you can see some of the sort of outcomes of the engagements in the public domain. I won't go into detail, but essentially you can see that some of the companies are setting new emissions reduction targets on different time horizons, committing to investment in renewable energy as a means of achieving those targets and also improving alignment position, and also commitments to exit from different high carbon emitting activities. You see that in the reporting. Next slide. And moving on to cement and aviation as an example, these I mentioned where we measure emissions intensity against IEA scenarios. And I mentioned why we choose this 2030 target, because it's about both existing technologies being invested in and involvement in new technologies on that slightly longer time scale. Here we see, many of the companies are a significant distance from that target. We set very specific sort of gear the thresholds to the pathway. You see here, significant means that they need to reduce their emission intensity by more than 36% to reach the 2030 target, or more than 20% in the case of cement. So, there's a lot of work to really drive down emission intensity using a range of different measures. Next slide. You can see the different results here for the focus companies, and using these results, you can sort of benchmark both between the different companies. So there could be more engagement effort focused on, if you like, the sort of laggards in terms of their emission intensity. And it could be a number of reasons for that in terms of their mix of production technologies. And you can also have a focus on just how far away they are from the target intensity, which you can see the white line there for each of the sectors. Next slide. I think this is the last of the slides. And this feeds into the suggestions we made for engagement. We see that many of all of the companies in the focus group set, then none of them are yet on the pathway. And in fact, they're behind the 2021 value in the scenario. So what does that mean in terms of engagement? Possible questions could include, like, what combination of investments are planned in order to converge with the target, and by when? And then how are companies engaged in technological developments required to realize the required emissions reductions, bearing in mind that they're likely to be a combination of both existing technologies that would require implementation and involvement in projects to bring on stream new low carbon reduction technologies, or in the case of cement mixes or formulations that require further development. So really kind of requesting that from the companies and sort of pushing them to focus on a slightly longer term time frame in terms of their capital commitments and R&D commitments. And I think Daisy, that's the last slide. We just check. So, oh yeah, and I think just to illustrate how that's coming through in engagement outcomes, actually you can see that's starting to happen for a number of companies, both emissions targets being set on pathways, but also capital allocation to this mix of technologies available and developing technologies in order to meet climate ambitions. So I think we can see some progress starting to come through from using this, putting this type of metric in the hands of the investment engagee teams. Okay, I think that is the last slide. So hopefully that's given you an overview of both the metrics and also how they're being used as part of the engagement, and also the types of outcomes we're starting to see from the types of questions and requests that are being put to the investee companies. Thank you.
Great, thank you. Thanks a lot, Nick, for your contribution. We now go towards the end. We would like to finish with some closing remarks before going to the Q&A session. We have already some questions on the chat that are unanswered, but we will cover them. But before that, we wanted to close our interventions by just trying to set the theme clear and to try to show you that with Pacta as a methodology for not only company but portfolio alignment, the main aim is to contribute to all the financial system efforts, like either regulators, supervisors, financial institutions, asset owners, asset managers, the whole financial system effort to assess the alignment of portfolios with climate benchmarks, and to give the resources to steer capital towards a net zero pathway. So when we started today, we say that there is this need to mobilization of capital. So this is one of the things that we wanted to let you go with today. So Pacta is one of this approach that allows you to measure the portfolio alignment with climate benchmark, but also give you some of the first strategies and tools to analyze and to identify how to steer this capital towards the net zero transition pathway. This assessment is again, we hope and it is expected that it help you as asset managers, as asset owners, to internalize also these climate change risk and opportunities assessments into some of your main decision-making strategies, and also to design and development of engagement activities also. It is very important for us that it's clear that the case studies that we present here are only 2 out of the many other examples of how Pacta can be used, of how we can use results that can be turned into practical actions. So what we saw today is just, again, one of the 2 use cases that can serve us to inform our decision-making, the development of our strategies, also to give us some elements of how do we or how should we start thinking about engagement actions. This is only 2, again, out of the many other ways and like pathways to think about how to use Pacta, and we wanted to show you these main 2 examples. So with that, I think we have already some questions. I guess, yes, we had a question at the beginning for Maria, and it's related to how do you manage short-term risks of shrinking investment universe when the industry is not moving at the same pace as you are? Wouldn't you lose investment opportunities to other lagging institutional investors?
Okay, yeah, that's a very good question. So maybe first I would like to begin by clarifying that we did this project from the asset manager's perspective. So the idea is to create this investment alternative, this fund that can motivate institutional investors to steer capital towards a net zero pathway. That is what Daisy was mentioning, that is the big goal. So it's one of the alternatives that institutional investors will be able to use to accomplish just that. But from an institutional investor perspective, you're right, there is a risk because if the market is not moving, then you'd be off benchmark. You would be outside of the market if you focus only on alignment. And in the short term, that can turn into risk of shrinking investment universe. I think this has to be, it's a transition and it's a disorganized transition. So this has to move at the same, in parallel with changes in regulation and also changes in the companies themselves. But we believe that in the medium to long term, this actually fits the fiduciary duty, because a portfolio that is more aligned with a below 2-degree pathway will be less exposed to climate, physical, and transition risks. So in the short term, yes, can represent a risk to be aligned, but in the medium and the long term, that will be the opposite, cover climate risks. And I think also that we have to begin. We cannot wait until the market is aligned so we start investing in companies that are aligned, because we also need to, as investors and institutional capital managers, we have to signal the market. We have to say we have demand to give more or easier access to capital to those companies that are moving towards a net zero pathway. And we can use this again in conjunction with engagement strategies. We have to have these conversations with the companies, because otherwise it will everything be slower. If investors do not engage and regulators do not put stringent enough regulation, then the companies will have less of an incentive to move faster. I think also having a process that considers the alignment of companies and to monitor it over time. It can also give you or give us insight on how the alignment starts to correlate with the performance and how companies that are moving consistently in a pathway of lowering their emissions and investing in new technologies that make their processes more efficient and etc., then it can for sure allows us to make more informed investment decision and to investment decisions and to spot which are the leaders. That's what I would say. So yes, you're right. In the short term, there is a risk. We have to move not alone. We have to also move next to a regulation and next to the companies. But we cannot wait, because in the medium and long term, alignment will cover for risk that come from climate change. And also in the meantime, we can signal through engagement and through asset allocation that there is capital steering towards net zero.
Yeah, very clear. Thank you, Maria. And during your presentation, you mentioned also like this lack or this differentiation of, for example, Latin America as a region with compared to Europe or the US, for example. And I think it applies now that that we have here some of the asset managers and institutional investors of Malaysia, who is also like one of these emerging markets that just is starting with this. It is still a long way for all of us to catch up if we compare to some other regions. And in that sense, what do you think that have been the main challenges for Sura in implementing this project in the context of Latin America?
Yeah, well, challenges are many. I think what I was mentioning before, the configuration of our capital markets and our economies. If the economy is not aligned, then it's hard to create an investment strategy that has a consistent return over time, because usually, at least in our case, I don't know how is the Malaysian case, that pension funds by regulation have to compare their performance to a market benchmark, a broad market benchmark, and all pension funds do the same. So if that broad market benchmark is not aligned and you are trying to align your investments, you will always be off benchmark, and it's going to have a higher tracking error or higher volatility. And in some cases that would be more convenient, but in some other cases, it's going to be the opposite. We saw it with the pandemic. When the pandemic happened, ESG funds that excluded fossil fuels had a great performance, and now in the context of the invasion from Russia to Ukraine, we see the opposite. We see that now the price of fossil fuels has gone up, and then the performance is the other way around. So I would say, yeah, the configuration of the market and the regulation, it's been challenging on the one side in terms of the market structure, but also internally, there have been challenges as well walking in this journey, because this is a knowledge that we didn't have, that we have been acquiring. At the end of the day, it's a capability that we have to create in our processes and in our teams. And in that sense, this partnership with the Pacta team has been very valuable to understand what are these important, what are climate scenarios, what are these metrics that Nick was talking about, what are the alternatives that as investors have to motivate this reduction of emissions in the real economy, how do we analyze the alignment, etc., etc. So it has required us to study, to train our team, and also to work with partners that are experts in the matter, to combine expertise from our side, investment management, and in the case of you in the Pacta team, the expertise on climate alignment analysis. And I think also another challenge is to anchor this in our reality. I think that is very important. Decarbonization doesn't mean the same in Europe than it does in Latin America. I mentioned the reasons before, but I would add another one, and is that, for instance, in Colombia, where I'm from, the main source of emissions is deforestation and changes in land use. And the companies that are driving, or the causes that are driving deforestation, are not necessarily the companies that are listed on the stock market. So we have to come up with different strategies to think about solutions. In the case of this Paris Aligned Fund and the research that I presented, what we did is to include a more stringent criteria when we're analyzing ESG controversies as part of our investment process in general, to do not accept companies that are in any way associated with deforestation. For instance, there are a few, as I mentioned, it's not like all the companies in our portfolios are driving deforestation. There are a couple in Brazil that are connected with the beef supply chain. So yeah, for instance, those companies cannot be included in this portfolio, and actually we're not investing in these companies anymore because this is a key issue for our reality. So that's another advice that I would give when we're trying this out. We have to anchor it in the reality of our context and what's relevant for our context. The same way, that's why as part of our conclusions, we said, okay, maybe a Paris Aligned Fund is not the way, or we have to open up a bit what Paris alignment means in Latin America and include also a climate transition perspective, which are the companies that are moving towards the net zero, towards alignment. In Europe, for instance, then yes, maybe since the carbon price is a lot higher, there is more regulation around decarbonization and moving away from fossil fuels, it could be easier to create a Paris Aligned Fund. Or if you have another perspective, not of alignment, but of, I don't know, low carbon, then it could be possible. But in our case, what is relevant in Latin America is to spot those companies that are making the efforts and those laggards to engage with and to try to mobilize them towards more ambitious climate action. So yeah, those are some of the challenges.
Yeah, great. Thanks for sharing, Maria. I will now go to Nick to help us. I think you already during your presentation, Nick, like cover one of the questions from the chat on how do we, or how institutional investors can engage with clients on decarbonization pathways. I think this is some of the things that you mentioned already. But if you wanted to give us like some, yeah, maybe expectations on how do you think that we can use some strategies to make this engagement effective? Like, do you think that there are any metrics that can be used to track the effectiveness of these engagements? If you have some words for that.
Yeah, I mean, I think this is, I mean, very much the intention with the metrics for CA100+ is that we're actually giving them metrics that are sort of close, give them useful information in terms of what they can bring to the discussions directly with companies, and focused on their decision making in terms of capital commitments and plans. So, you know, they can look at the different technologies that a power company has, or in the case of the automotive company, in terms of the different types of vehicle technologies that they're producing. They can clearly see from the results how each company compares with what is being anticipated along the pathway for each of those sectors. And they can, you know, I think just with the headline metrics we provide, they can really see this sort of alignment position expressed not just in terms of, not in terms of emissions, which is obviously an important metric in terms of the sort of overall outcome we want, but it's expressed in terms of the actual technological changes and investments that the company needs to make. So it's intended to be very practical, and from that, very specific kind of requests can be made, and outcomes expected from investee companies that relate to their capital investments and their revenue and the activities of the company. So I think the aim is to be very much sort of giving them decision useful information. I think that's, you know, that's the aim here. with the emissions intensity metric, I think I mentioned that we set this slightly longer timeframe, 2030, because that stimulates a focus on the different underlying mix of technologies. And in those sectors, it's a combination of different measures that will be needed. You can see that in the pathway. But by setting it 2030, we kind of stimulate thinking both on the very near term, what they can do, and also for those companies to be involved in activities that are sort of looking to 2030, 2035, and how they will, get the emission intensity down. So again, it's trying to, through the engagement, kind of making requests that sort of drive the company to look at those capital commitments and the technologies that they're involved in.
Okay, great, thank you. We have also a very specific question. I don't know, Nick, if you want to help us on that. How about for countries where energy prices are a sensitive topic and cheap subsidized electricity are a staple? How would you strategize stewardship or engagement activities around this issue?
Yeah, I mean, this links a little bit to what Maria mentioned in terms of a kind of regional or local focus. I mean, a number of, one way to kind of reflect this in alignment measurement, the kind of metrics we showed, is to use regional scenarios. And these usually take into account the kind of and adjust the emissions reductions according to the development pathway of the region or the countries in that region, taking into account also sort of just transition considerations as well. So I know, for example, if you compare Europe with some of the regional pathways for Asia, the sort of phase out timing for coal power is slightly different because of the needs for investment for development. And so the kind of way in which you measure alignment along the pathway is adjusted. And the kind of the needs of that region in terms of providing affordable energy, both to industry that is still growing, and the population is taken into account in that pathway. But for that, you need to move to a more regional or local pathway as the basis for the alignment measurement.
Yeah, and I think it actually relates to some of like other question, George. I saw that you were answering about the decarbonization pathways. Do you want to say some words about it, George?
Yeah, just to mention that we have a kind of a brief digestion of some of the different scenario pathways out there. You can follow the link I've just posted in the Q&A box. And Nick, I think we have an increasing amount of work kind of summarizing some of these decarbonization pathways. I'm not sure if there are any resources that you have off the top of your head as well, Nick, to mention now.
Yeah, I mean, in terms of understanding pathways, I mean, we could, following this session, we could give a link to the scenario, one of the scenario background documents, which has a kind of toolkit of different reference work on sort of choosing scenarios, and also how the scenarios are developed. So we could provide us some follow-up information.
Great. And I think it links quite well to our last question and is related to data, actually, the need for the data for all this analysis. And this is a question for you, Maria. You mentioned during your intervention that you not only use Pacta on this like investigation or on this research, but you were also relying on some other information like company disclosure and some other metrics and like resources. Do you think that there is still we know that there is a significant gap in the disclosure, but how do you think that this affects these types of analyses, or how do you think that we can tackle these data gap issues?
Yeah, that is a a critical issue, not only for climate analysis, but ESG in general. That's also a gap that is going to be closed in the coming years as regulation also moves forward in that respect. For the research, we use different data providers to get the data for the absolute emission, intensity of emissions, decarbonization targets, and so on. We used CDP, for instance, and we used 2 other data providers that we pay for. And out of the 204 issuers, we found data of 60%. So there's still quite a gap. Almost half of the issuers don't have a disclosure. What we realized is that first, not all of them reported to CDP or were covered by our data providers. So in that sense, data providers have to amplify and expand their coverage. But some of them do disclose it on their corporate reports, but others do not disclose. So I think the way to move forward is engaging. Again, I think I want to emphasize that engagement is crucial to be aware of the power that we have as institutional investors and institutional asset managers to mobilize company actions, to be persistent in requiring information directly to companies. That's why in our pilot of engagement last year, that's one of our focus of area. For instance, we found, of course, that companies that belong to Pacta Sectors have more disclosure because they have more scrutiny from regulators and the public in general. But banks and financial institutions that are a big part of our market didn't disclose so much about their climate action. So that's one of the groups that we targeted for this first engagement. And we were surprised because there were actually a couple of banks bringing some ambitious actions to the table that we weren't aware of. So engaging and waiting until the regulation also demands that from companies. I think additionally, one of the additional values of the Pacta tool is that it has already a very robust data base of very detailed information from many companies across the world, and at least the free online tool, we can all use it. So that's already something that it's very good because we have forward-looking data from a lot of companies that are listed or that have issued bonds. So yeah, I think it's a combination of going directly to public reports, using different data providers, which is challenging as well, because you need to understand the different methodologies, if they estimate the emissions, or if they take the data directly from the disclosure of companies, if that information is verified. Right now we're advancing in measuring our financed emissions in partnership with PCAF, and the quality of the data remains a challenge. So yeah, I think we will have to coexist with that for a little while, but engaging on more disclosure and alignment of that disclosure with international frameworks, it's a good starting point.
Yeah, I agree, Charlie. Great. Thank you. I don't see any other or additional questions on the chat. So I'd like to finish today by thank you all again for your time. Thank you, Maria, for your contribution. And thank you also, Nick, for your time to share some of the work that we've been doing with CA100+. Thank you again to the Sustainable Investment Platform for helping us to host these spaces for conversation. Also, thank you to the UK Pact Malaysia, who has been provided the funding for this project. We encourage you all to go to the platform. As Maria mentioned, there is a free tool that is available for institutional investors to use and to learn more details if you have not about the Pacta methodology. We encourage you to reach out to us and send us any remaining questions that you might have. And yeah, I think we can close today. Thank you all for your time, and have a great afternoon. Thanks.
Thank you.
Thank you. Bye-bye. Good afternoon.
Thanks, everyone.